Hello, everyone. Welcome back to our discussion. We've talked about the crisis in financial institutions and the stagnation in transportation. All of this ultimately boils down to one thing: people, the final payers of the U.S. economy, American consume. Wall Street narrative has always been the U.S. consumer is strong, their balance sheets are healthy. Indeed, if you look at averages and the wealthy who own stocks and homes, they are indeed rich. But if you look down the pyramid, you see a completely different collapsing world. Here I introduce the third group of Canaries: Tricolor Holdings, Ally Financial, and Credit Acceptance Corp. The climax happened in September 2025. A company called Tricolor Holdings suddenly filed for Chapter 7 bankruptcy liquidation. Note: Chapter 7 means immediate shutdown and asset sale, not Chapter 11 restructuring. What does Tricolor do? It provides auto loans to low credit score people, mainly immigrants and low-income workers. These people usually can't get bank loans due to no credit history or low scores, so they turn to Tricolor and endure sky-high interest to buy a car. In America, no car, no job, no life. Tricolor rear collapse is not just one company failing. It did an earthquake. Just before bankruptcy, in late August 2025, one of its major funders, Fifth Third Bank, disclosed buying suspected fraudulent activity in Tricolor loan day. This lifted a terrifying lid. To maintain growth and securitize loans to sell to Wall Street, Tricolor may have been window dressing, hiding the fact that underlying borrowers were completely unable to repay. Tricolor referred triggered a domino effect. We saw listed auto lending giants Ally Financial, ticker ALLN, and Credit Acceptance Corp, ticker CACC, also show alarming data in Q3 2025. Ally Financial and retail auto net charge-off rate soared to 1.88%. For a bank of this size, this is approaching the warning line. Painting, for every $100 lent, almost $2 is gone forever. Even worse, the delinquency rate also hit new highs according to the latest Fed data. In Q3 2025, credit card and auto delinquency rates in low-income DIPL codes have surpassed pre-2008 crisis levels. This is an extremely dangerous signal. It tells us that, although inflation may have come down nominally, years of high prices and high rates have completely drained the savings of lower-income American families. They can afford new things and can't even service existing debt. And this pain is spreading from subprime to prime. Remember, buy now, pay later. Companies like Affirm and Klarna were once young people being favorite. In 2025, delinquency rates are rising even on these platforms. Although Klarna claims declining delinquency, independent data shows it came from tightening standards. Overall, BNPL debt burden remains heavy, especially for users juggling multiple platforms. From social media to falling government approval ratings, everything points to one fact: appetite for middle and lower income Americans is deteriorating visibly and rapid. This consumer weakness also explains the bear Monkey tale of two cities we mentioned last episode. In semiconductors, it my ice and fire. On one side, Nvidia and Bulwav riding Gemini 3 and AI data center boom, stocks soaring, living in the future. On the other side, analog chip giants serving the real economy. NXP and Texas Instruments are shivering. NXP admitted in Q3 that its automotive customers are undergoing painful inventory adjust. Cars aren't selling, remember Tricolor. So car makers stop buying chips. Texas Instruments gave dismal guidance, warning industrial recovery much slower than expected. Mobileye, despite raising full-year guidance, grew revenue only 4% in Q3, relying entirely on inventory drawdown, not real demand. This open triple canary tells us AI may be the only growth driver right now, but it should a single pillar, unable to support the whole economic building. While you cheer AI changing the world, remember your car, fridge. Factory machines are rusting because no one can afford them. This chill spreading upward has even touched the top of the pyramid. The usually cash-rich wealthy in our final episode will look at the luxury market, listen to Rolex and LVMH size, and how we should respond. We covered Blue Algae credit crisis, FedEx logistics stagnation, Tricolor rear bottom bankruptcy. Some might say, these are just problems for the poor or middle class. The rich are fine. As long as the rich keep spending, the economy holds. That brings us to the very last canary, luxury goods. The wealthy are usually the last to feel the chill, because their wealth is tied to asset prices, but this time even they are tightening their belt. Look at luxury emperor LVMH. In its Q3 2025 earnings call, this normally arrogant company used unusually cautious language. Its core fashion and leather goods division posted negative growth, -5%, the first time since the pandemic. Management admitted not only China weakness, but affluent Americans and Europeans are also becoming price senses. This marks the definitive end of the 3-year post-pandemic revenge spending era, an even sharper unofficial indicator for Rolex secondary market prices. In recent years, buying more Rolex was investment, but in November 2025, according to watch charts, popular models like the Daytona continued falling down more than 30% from 2022 peaks, some even below retail. Why does this matter? Many Rolex secondary buyers are SME owners, crypto players, finance professionals. When they start selling watches for cash or stop paying premiums, the era of excess liquidity is over. Cash is king again. Now let's put all the puzzle pieces together. One Blue Owl tells us, corporate credit valuations inflated, liquidity drying up, shadow banking facing, run risk to FedEx, and cardboard box data tell us. Physical goods circulation at 10-year low, retailers aggressively destocking, no hope for future. 3 Tricolor and Alley tell us, bottom-tier consumers unable to service debt. Wave of defaults erupting. 4 NXP and TI tell us, outside AI, traditional industrial and auto manufacturing. In Recef 5, LVMH and Rolex tell us, wealth effect fading, even the rich cutting spending against this Prubai recession puzzle. Stands the S&P 500 parting amid Gemini 3 demo videos with dreamy AI PE multiples. This extreme disconnect between macro fundamentals and stock performance is the classic hallmark before every major crash in history, like the 2000 internet bubble, clicks over profits, and the 2008 subprime crisis. Housing prices never fall. So what should investors do? Sell everything, buy gold, hide in a bond? Absolutely not. My advice, stay vigilant but don't panic, adjust but don't exit. Though the canaries are singing, we must acknowledge the AI productivity revolution is real. Gemini 3 in multimodal reasoning could genuinely boost productivity in coming years, supporting tech giants' earnings. And policy is unpredictable facing such a complex situation. The Trump administration won't sit idle before midterms. The new Fed chair will surely fire up the printers again. So I prepared and bid investor Canary arm system for everyone at these indicators to your watch list. First, watch Blue Owl, ticker OL, like a hawk. If it fails to stabilize in coming months, or the OpenDC 2 merger ends badly, that the first gunshot of private credit bubble burst. If OWL breaks $12 key support, consider heavy reduction in financials. Second, monitor high yield spreads. Junk bond yield minus treasury yield. Currently around 300 basis points, extremely abnormal low. Once the spreads blow out past the 400 or 500 basis points, market repricing junk debt held by Blue Owl's escape time. Third, real escape time. Third, beware the end of boom bad news is good news. Logic. Markets use to interpret weak data as boom all Fed will can, pushing stocks higher. But when real credit events like Tricolor bankruptcy and Blue Owl locking redemptions occur, rate cuts can cure defaults. When bad news becomes bad news, the drop will be brute. Finally, one last sentence for everyone. When the canary dies, it doesn't mean the mine collapses next second, but it means put on your oxygen mask, stop greedily digging, and look toward the exit. Blue Owl is now lying on its perch, gasping. Its song is growing fainter. Can you hear it? This concludes our in-depth analysis of Brady OS's stock market canines. I hope this Blue Owl becomes your lighthouse in the fog. The above content is for informational purposes only and does not constitute investment advice. Thank you for your attention and companionship.